Everyone. It's hard to believe we are only 2 months into FY 2026 because the whirlwind of events has made it feel much longer. From the ever shifting narrative around tariffs to the deeply emotional Operation Sindoor and the intensified escalation between Russia and Ukraine, the global landscape feels anything but stable. In times like these, when the news cycle is relentless and the future feels uncertain, it's worth taking a moment to pause and look at the bigger picture. Today, we'll step back from the chaos to reflect on where we are headed and why long term thinking might be our best guide through short term storms. We are happy to have back with us Mr. Sahil Kapoor. Sahil is the Senior Vice President and Head of Products at DSP Mutual Fund. With an experience of over 18 years, he is one of the most respected voices in the industry, known for his fresh ideas and perspectives. While most fund management teams tend to focus on outlooks ranging from a few quarters to a few years, he has consistently guided us through the lens of long term businesses, country dynamics, and capital market cycles. Welcome, Sahil. Glad to have you back with us.
Thank you, Meghna. Glad to be here.
Sahil, your emphasis on assessing long term valuations rather than just relying on 5 to 10-year averages and has been the key guide to managing volatility for a lot of advisors and clients alike. Given the current market landscape, what are your key reflections as far as broader macro trends are concerned?
So my sense is that when we look at the markets today, you will see that there are no bargains available. When you look at the Indian markets and look at the long-term history, so you get two, three very clear perspectives today. One is that over the last 25 years or so, our returns have been, slightly more patchy in some phases. But when you look at the aggregate 25-year performance, our returns are very good. Indian, let's say only Nifty 50, barring not looking at other indices. When you look at only Nifty 50, you get to see a CAGR return of about 19% annualized. It's a fabulous number, right? So what it does is it hides the fragility that system goes through various cycles. For example, there are many instances in the past when uh, historical returns were not so good like they are today. So what it does is it creates an illusion in our mind that this is what we deserve and this is what we're going to get in the future. So that I think is probably something sort of a false narrative which gets built up in our own mind. Behaviorally, it's a problem. We get very hooked on to the recency bias. And second thing is that it's, as I said initially, it's hard to find bargains, right? Markets have done well, so investors have sort of piled on into things which do well, right? And you will see that that percolates into reducing the number of opportunities which are available, which can give you a similar outcome in the future, right? So two, three things. One, macroeconomic numbers, I think they appear to remain fairly good. I think we are growing at about 6.5% on an average. Although our aspirations are 8%, but we are not there yet. We are at 6.5%, which itself is a very good number, right? No denying the fact. If you add 4% on top of this number, growing at about 9 or 10% nominal growth, I think it's a good number to have. So if our earning growth can also be around 9 to 10%, uh, the only missing piece then remains the valuation, right? That I think is not very favorable in case of India. When you look at, let's say, the top 500 stocks or so, you will be hard pressed to find bargains. So I think that is a missing piece. If we get that aligned, then possibly investors can have a much more open playing field to hunt for opportunities. Macroeconomically, I think we are doing fine. Um, I won't say that we are hitting sixes out of the park, but I think we are having a middling growth, a sort of a monetary policy which is benign, not very restrictive, right? And earning growth trajectory which is also benign. Um, it's not falling off the cliff. So I think these are good ingredients for the longer term, but we need to be very careful for what we pay for this growth.
There is no denial that we are one of the few countries which have a potential to grow at 6.5%. And of course, as you very rightly said, if the valuation support, uh, you know, uh, decent returns are likely. So let me just change, my lens from a very long-term orientation to slightly short-term. If I look at returns year till date, the equity returns have, by far been muted. However, if I see, bonds or gold or precious metals, they have actually done pretty well. And the USD also has corrected significantly. So, my question to you is, how do you rate different asset classes at this point in time on a risk to reward matrix?
Mega, I think there are not many asset classes today which offer a bargain, right? And that is something in the past which has been highlighted as a all asset rally, or in US it has been dubbed as all asset bubble, right? Which all assets are doing well, right? Barring gold, which started to do well only in the last 18 to 24 months, most other assets have been doing well globally. And the reason has been that now we are close to about 15, 16 years of ultra loose monetary policy globally. Huge amount of money printing which has happened over the last 15, 16 years. That continues to be the case. But when you look at, let's say, shorter term, uh, two guiding principles are important. So let's first look at equity markets. So Indian equity, when you look at, let's say, Nifty 50, FY25, which is March 2025 ending, the annual YOY EPS growth is 1%, right? And still the markets haven't done poorly, right? They have still outperformed the earnings, which means that even in FY25, you had PE re-rating based on how earnings were growing, right? So, which is sort of fabulous, right? You are in the fifth year of the bull market, your earnings slow down, but still the markets don't, give you abundant opportunities on the downside. It continues to be where they are. Second is that this is, I think, any 5 year or longer bull market that we've seen historically, which did not have a single 20% correction, right? So since the bottom of the COVID, all corrections in India has been less than 20%, in fact, less than 17%, um, and which is a first, right? So you haven't seen the kind of volatility or corrections that we've seen in the past. And third is that there is also this expectation or a narrative that gets built that how it is, put in numbers, that we get 10% correction every year, we get 20% correction every 5 years, and we get 30% correction every 10 years. But this hides a very important metric. What is that? That the worst of the past is not the worst of the future. Because if that was the case, then it would not be the worst, right? So our sense is that we should always be aware about where the margin of safety is currently. And I don't think that when you look at equity markets as a whole, you will find margin of safety from a top-down perspective. You'll have to go bottoms up, hunt for opportunities, hunt for sectors, hunt for companies, and then you will find a few bargains or few average opportunities where you can deploy your money, right? When it comes to, let's say, alternate assets, let's say when you talk about gold particularly, last 2 years it has done remarkably well. Around 2.5 or more years ago, I think we highlighted that the gold market is very tight, right? The demand and supply situation is tight. All other factors like debasement of currencies, huge amount of debt being piled up globally, indicate that there is margin of safety for gold for it to do well. We didn't know that central bankers will be the ones which will create demand for gold, and eventually that played out, and prices jumped higher. I don't think this is the time to second guess the gold bull market. I have seen that a lot of investors, I have heard queries, heard comments also. A lot of people trying to, pinpoint the top for gold. Um, how I think about it is that this is an asset class which is non-linear. It's not easy to value what is the price for gold, right? So once a bull market starts, you don't know how investors perceive the real value for gold to be because it doesn't have any yield, right? You cannot have a DCF for gold. Although I have tried to put a metric called how to value gold and silver, people who are interested can go back and check that. So, but I still feel that once a bull market in these alternate assets starts and the reasons for those bull markets don't go away, I don't think there is any merit in picking a top for gold, and you should just continue to be invested and probably be overweight on precious metal, maybe gold and silver both, right? Bonds, I think we had a fabulous time where duration has done really well over the last 2 years. My sense is that the incremental benefits from running a very high duration will slowly tend to go away as you see yields decline further. And that remains to be seen. Maybe in calendar year 25, that play could probably get over, and you might be better off reducing your duration slightly. So as I said, equities very hard to find bargains. Gold has done well, but you continue to remain invested. Bonds, debt, the meat of the duration move has already been captured by 1.5% move in the 10-year yield. And global, I think the opportunity is very selective. There are countries and companies which are cheap globally, available at bargain prices, but they are not easily accessible, right? You have to find a route to go and invest in them, which is hard to find in India as of now, uh, because mutual funds, overseas investment limits are restricted right now. So on the whole, I think currently a multi-asset approach remains the key, where you have to adjust your exposure as per where the margin of safety lies.
You made a very pertinent point of, not seeing any correction in the last 5 years. And that, that honestly actually bothers us as well. And if we just try to find out one cause of this, it could be probably attributed to the domestic institutional investors and, the retail flows that have been moving towards the SIPs. Now, there's a school of thought which says that it is structural and it is here to stay.
Hmm.
But and what we've also observed and noticed is the fact that every minor dip is actually getting bought into, which is further preventing any substantial decline as far as the markets are concerned. But as you always say that it is returns that drive flows. What sense do you make out of this trend, and how far do you think that this will continue?
Yeah, there is a phrase called post hoc ergo propter hoc. It's a Latin phrase. It means that after this, therefore because of this. So what we do is that once we see something happening, we tend to connect these two things together. So for example, you see that there is a huge amount of SIP book which has been built, and you see that markets have done well. So we link them together and we say that returns have come because of SIP, right? Or markets haven't fallen because there are huge amount of SIP flows. I remember back in the 2003 to 8 cycle, SIP, if you could just replace that term with FI money, you will have exactly the same statements that we have today, right? And prior to 2019 cycle, you could say that the same thing for DI money. A lot of insurance companies were purchasing stocks at that point in time. My sense is, as you rightly said, that flows don't create returns; they follow returns, right? Think about this way: that if Indian markets had not delivered 12, 13% CAGR, or let's say the 20% plus CAGR that we've delivered in the last 5 years, would we have the same amount of retail or mutual fund flows? I don't know the answer to the question, but it's not as clear, right? It could have been, it may not have been, right? So it's not very clear. And therefore, if there is even one data point which can falsify a theory, it is enough to tell you that the theory is not right. So I would probably think that returns which are excellent or recent returns which are very high are one of the reasons that why we have these flows. Maybe incrementally they could have blunted volatility. It's quite possible, right? That a lot of retail participation or any kind of money, it comes and buys stocks whenever there is a decline, and they continue to buy these stocks and blunt volatility. It's quite possible, but can it, help contain all declines? I don't think so. So I'll tell you why. And it's a very, very important point and not discussed enough. Think about this tomorrow when the market opens, if you have a black swan event. What's an event which is rare and has a very high impact and it cannot be predicted? Such an event. It could be anything, we can't predict it today. And assuming that the market opens 10% lower or 20% lower, it can happen, right? It has happened in the past many times. And even in US, it has happened on a few occasions. What does that mean? That you do not need any selling from existing shareholders for the market to open 10% down. In fact, when you go back to see these occurrences when markets open 5 or 10% down, you will see very thin volumes being traded, a few shares and the market closes, right? What does that mean? That the direction of stock prices are decided by incremental flows, right? On that very day. And they could be anything, right? And those events are rare. And therefore, whatever flows or shareholding you had until tomorrow cannot move the market tomorrow. So whatever you had till yesterday cannot move the market tomorrow, right? So it's a fallacy to believe that XYZ factors will continue. And that fallacy, comes from thinking that the longer term future is same as the longer term past. But we've seen time and again that is not the case. We get surprises again and again, and we forget them again and again, and the cycle repeats. So I would say we have to take it with a pinch of salt. And also, I don't think that let's say putting names on flows makes a lot of sense. So we demarcate flows through FI or DIA or SIP or mutual fund retail. I don't think it's a great idea. Eventually, um, sometimes I think about what are FIs or what are institutional investors. They are same as people wearing a tie and going to the office, right? They don't have anything different from other individuals. Maybe they have more information, right? But it's very clear that more information does not mean better outcomes, right? So marginally there will be some very smart investors, but most investors by and large will be just average, right? So their ability to have um, very large impact will be very limited. So I would rather avoid this frame of reference in terms of any particular set of investors blunting the future outcomes. I don't see it that way. It can happen because of any event which we don't see today.
Now let's probably change our focus to what is the most important ingredient in shaping returns, which is earnings. Right now, if we look at Q4 results and also FY 2025 earnings, it's been rather a slow year as far as most companies are concerned. There have been re-ratings and a noticeable slowdown for most sectors and companies. Now, rural consumption, at least in India, has shown some amounts of resilience, but the broader sentiment does remain subdued, and there is no denial about it. Uh, but however, if I contrast it to that in the US, it is quite evident that the earnings have been holding steady. Also beyond the Magnificent Seven companies, and it's been almost like it's just been a contrasting image as far as Indian and US earnings are concerned. So my question to you is, how do you expect corporate earnings in FY 2026 to pan out? And from a valuation standpoint, do you find more comfort in India or in US at this point?
I think both the markets lack margin of safety. In US, the problem is that when you look at the very large companies, the Magnificent Seven or the top 10 companies or 20 companies, their market caps are not small. Although they continue to be extremely profitable, they continue to generate huge amount of free cash flow. But their earnings growth, which was closer to 15% CAGR, is now coming down to about 10, 11% CAGR, which is still very high in dollar terms, right? So that is what is holding up these companies and they continue to do well. I'm not sure. I don't have the ability to forecast what their earnings will be, but look at their numbers. Over the last 50 years, S&P 500 average multiple has been around 15 times or so. 2018, the average multiple was around 16 and a half times, right? We had no COVID, no war, nothing. 2018, very normal type of an economy. Today, those multiples are closer to 25 times, right? And so I'm not sure what to pay for aggregate stocks. Again, you have to be very, very choosy. And there are, of course, there are sectors like biotech and some other sectors in the oil and gas space in US which offer opportunities. So because it's a very large market, it always has some opportunities. But when you do a broad brushing, it's hard to find bargains, right? In US, in other geographies, right? There are bargains available. When you scout for bargains in Eurozone, in China, in parts of other emerging markets, you will find bargains. There are a lot of companies, right? So from a global standpoint, I will be more focused on buying the right business at the right price rather than thinking about a country. Right? That is how the approach should be. Domestically, um, as I said earlier, let's assume that we continue to deliver 10-12% earnings, which we did not in FY25. Let's hope we'll do in FY26. If you're growing at 10-12%, NSE 500 has an ROE of around 15% or so. If you grow at 12-13% also, I don't think you deserve a multiple of 25 to 28 times, right? So we've been holding on to those multiples for a decent last 2 to 2.5 years. My sense is that if you get a derating in that multiple, that means a correction in the stock price, your investing journey will become more robust, right? If you don't get a derating and prices continue to remain high, your margin of safety is likely to be compromised, and future returns will not be very different from, let's say, fixed income returns, or so maybe uh, the ability to generate a large positive meaningful upside could be limited, right? So that is how we should think about earnings. Domestically, largest companies or large companies are relatively better placed. Okay, not on an absolute terms. On an absolute terms, barring a few banks and maybe one or two healthcare companies or one or two large energy companies, it's very hard to find bargains even in large caps, right? But relatively, they are much better placed than the small and mid cap universe. So it could be a hiding place. But on an absolute basis, uh, either you wait for bargains to appear or let the time correction go through and earnings catch up, and that is how maybe some average valuations will come up or some event can trigger a correction, right? So either of these things will give you more margin of safety.
So, Sahil, starting from what you were mentioning, if I go back the last 1 year, your
Yeah.
monthly updates, it's been very clear that you have been saying that the valuation on mega caps in India and banking sector, especially the private sector bank, is looking attractive. And to your credit, if I look at YTD 2025, we have seen these two outperforming the broader market as well. Now, do you think that this is still holding, or like you mentioned, that on a relative basis, you're still fine, on an absolute basis, you're not comfortable? So, what is the narrative now in terms of opportunities within India?
Harsh, I think the largest companies are still better than the rest of the universe. The reason, as I said, relatively they are better priced. And second, I think they are also more robust. We haven't seen any new, problems or crisis unfolding. Whenever they unfold, larger companies are able to take it in their chin and, come out of the crisis much stronger. And that could be the case in the future also. Second is that when you look at these companies, so look at the top 10 Nifty firms, five of them made a new lifetime high, right? In the rebound that we've seen since the market bottom in the end of Feb, right? And many of these companies have also reported good numbers, right? Their earnings continue to be good. And in this portfolio of top 10 companies also has an aggregate return on equity of more than 20%. So the portfolio is also good, right? In terms of how it is placed. Valuations, again, once again, I'll say that it's not very cheap or even average. It continues to remain slightly above average, but you are still better off than participating in the rest of the market. Second is, how long will this outperformance last? I have no clue, right? It's very hard to say what will happen in the future. For example, in the last cycle, the outperformance of these large companies continued for about 2 to 3 years in India. But look at US, it has continued for 16 years, right? So you can't really say what will happen, but when you look at the complexion of the Indian economy, the way it is growing, the way the monetary policy is placed, the way the top line is growing, the way consumption is growing, I think it's fairly good to remain, in large caps and look for opportunities in large caps because they are relatively better priced, right? And unless you get bargains in small and mid caps, I think this is a category which will help you in good stead, even now.
So now I'll just change the discussion more from an investor point of view. Now, if you go back in time, life used to be easy. As analysts, as fund managers, you would say invest in India, invest in this market, and people would buy that, and they have made reasonable returns over a period of time. But now things are getting a little more nuanced. There are so many styles and factors which are being talked about on a day-to-day basis. Now, for an average investor, it's very difficult to understand What is value? What is growth, quality, momentum, all these things. So, two questions just to give an idea to our investors. One, depending on the cycle of the market or the economy, which style do you think respectively do better? And second, in the current scheme of things where we are right now, though you mentioned bottom-up stock picking, but still, if one has to understand, which styles do you think would do better in short to medium term?
Harsha, these are all guesstimates, right? There are no economic cycles which tally one to one with any style. And I have also stated in most of my reports that stock prices are more often not related to the underlying business, but to the whims and fancies of the investor at that point in time, right? So, in order to correlate, let's say, underlying factors, so you can divide them into two parts. One is the price-driven factors, which is like low vol or momentum, right, beta, etc. And the other is fundamental-driven factors, or which comes from the business, where you could say, value and quality. So these are two different type of factors that are available in the market today. All of them are statistical, right? You use a formula to arrive at what is value, what is quality. Unfortunately, the definition also changes with time, right? Of what you could define as value and what you could define as quality over time. So these are not static definitions and static numbers, and therefore it is very hard to say that a specific type of economy will favor a specific factor. Uh, how I think about it is, does that factor suit my temperament, right? So, for example, does value factor, which allows me to buy, let's say, good companies, which will probably weed out companies which have very high variability in their earnings or do not have too much debt on their books. It will weed out companies which are over indebted, right? Uh, does that suit my temperament? I think if that is the answer to that question is yes, then that factor is suited for me. Rather than trying to time the factor, right, which is also possible in some statistical way, I would probably time my behavior and see what factors help me do well over time. And second and more important thing that in terms of factor investing, most investors are better off thinking about these factors as very long-term bets, at least a decade or more, because all factors will have cycle, they will come and go, but over time, they more or less come and get aligned with itself. So, for example, if you run a 20-year data point, most factors will be in the vicinity of each other in terms of what returns they delivered, right? But the path is very different, right? Path could be very different, and that is what the investors should think about when they think about selecting factors for themselves. I still feel that it should be very simple if you are thinking about the longer term, and make sure that whatever factor or non-factor indices or passives or investments you select, they give you the ability to hold on. If that is possible, then I think that is the right factor for you.
The next question is about what we discussed also about SIPs.
Yeah.
Now, as advisors or our investors, we are often confused about believing SIPs versus valuation-based investing. Now, there are a lot of studies which indicate the benefit of SIPs, but what amazes us is that a concept which was started more to tame the behavior of retail investors has started finding its place even in the portfolios of ultra HNIs and HNIs. I have two questions here. One, if SIP as a concept is so powerful, why it is being talked about only in India and not in other major markets? And second, do you think SIPs can structurally distort the market and keep it into a bubble territory for a very long period of time because people are just investing in without looking at the valuation? And also, as an adjacent question, if you could guide our investors on what should be the ideal time frame of an SIP, is there any difference in return when an SIP started at the peak of the market or the bottom of the market? So if you could just give us a broader
Sure.
idea on these two, three questions.
So Harsh, I wrote a report called Seven Myths about the Market Debunked by Data. And one of the myths was that SIP is only for retail investors or non-professional investors, and where I highlighted that SIP has worked across the world. And the insight to that take ended with this question, that if SIP is such a strong tool, why is it not practiced at scale in most other geographies, right? And that is the same question you asked me. So I asked that question in the report. but it's good that you asked me that same question. I'll give you my answer. Uh, as I said earlier, that flows create returns. And when you see SIPs deliver significantly superior outcome for investors, people flock towards them, right? And that is what is happening domestically. Think about a guy starting who starts investing, let's say, in the Japanese market in, let's say, 1990 or 1995, 5 years after Japan peaked, right? So think about a new investor who is, let's say, 25 years old and now has some investable surplus, and he starts what is called the SIP. And it'll take about 15 years for him to break even, right? Now think about this guy sitting in India. He will break even in the first year, right? He will start earning returns. And therefore, even SIPs are path dependent, right? They work significantly well in markets which tend to either, let's say, stagnate or do slightly well over a 10-15 year periods. Right. So if you start with 100 and the market goes back to 100 over 10 years, you will still do well if you're doing SIP because your average purchases will be lower. But in a market which starts at 100 and ends up at 80 or lower, or whatever the number is, your outcome will not be very superior, right? So even SIPs are path dependent. It requires a market which does well over time. And therefore, there is an underlying assumption everywhere in the world that the stock market over time will deliver returns, right? If as investors we believe that, and if that happens, then SIP remains one of the most important tool for investors to do well over time. It was tested back in 1930s, then again Ben Graham tested in 1970s. Many other participants have tested it in 2010, 20. We tested it again and again. And every time it shows up that SIP is a superior tool. Okay. And you ask the question, valuation versus SIP, right? So in SIP, what you do is that you accept average outcomes. What you are accepting is average valuation over a very long period of time, and you are also accepting average returns. So when you do SIP, the main work is done by time, not by return. And that is a most important and powerful tool in compounding, which helps you do well. And once again, I'll emphasize the reason for it to do well over time is the time itself. And that time spent in the market is a reflection of your confidence that it will continue to happen. That means that if returns have come in the last 10, 15, 20 years, they will continue to happen in the next 10 to 15 years. Think about a market where, for example, China, if you go and let's say tell people that do a 20-year SIP, your outcomes will be very superior. He will show you an Excel sheet which shows negative returns. It will be very hard for us them to, for us to convince them that this is a tool that will do well over time, right? So it's path dependent, right? So this is probably the chief difference. And third question that you mentioned, does it make sense or does it differ when you start the SIP at peak or at the bottom? I think if your period is fairly longer, let me give two assumptions. One, if the period is fairly longer, it could be more than a decade or more, and that underlying market shows a meaningful performance, right? Shows a performance which is at least matches fixed income returns or more, then it does not make a difference whether you start at the peak or at the bottom. The reason is that over a 10-year period, whatever units you accumulate in the beginning or at the peak will become meaningless, right? So the number of units that you accumulate, let's say you start an SIP in 2008 peak, right? Your first installment goes to the market in January 2008, right? And you continue for 10 years. You reach 2018. In 2018, the unit price of the unit that you bought in 2008 January will be a small fraction of your overall corpus, right? So its ability to influence your long-term return will be much lower, and your average price will also be much lower. So mathematically, it becomes meaningless if the initial assumptions stand. What are the initial assumptions? That the market performs fairly well over this period of time, and you are able to hold on to it, right? And if they are true, then possibly your returns will be much better over time. And that is the catch here, right? We all believe that we can continue to remain disciplined, but I hope we don't have a market situation where we have a 5 year or 10 year lull phase. We had that in the past, right? 2018 to 13, 1992 to 2002. We had many such phases, and they are the test of character for investors. And I don't know how people will behave, or even I will behave if I see, for example, if I do an SIP and my 5 year returns are below fixed income returns, I don't know what will I think after the fifth year, right? It's going to be hard to convince yourself that this is the right thing to do, right? But it is the right thing to do. The numbers have shown that it is the right thing to do. So if you believe these assumptions, then possibly you will know that SIP is the right thing.
And to our investors, if you believe this assumption, then even if you have SIPs in small cap, mid cap, then it's prudent to continue because a lot of investors ask this question these days. Sahil, with this, we come to the final question, and this is to understand the opportunities and risks in the market. And why I'm asking you this question in particular is that because you have been able to pinpoint a lot of things which many other analysts and fund managers have not guided us through in the past. So, question is very simple. Is there any risk in this market where the market is completely ignoring, or is there an opportunity in the market which is being completely overlooked?
So Harsh, its market is always risky, right? There is no day or time in the stock market when all risks are priced in, right? We can never price them in. So there are, of course, many known risks which are going on, which all of us already know, right? Whether it is the war, etc., earnings, re-rating, opportunities in specific areas. All of these are known to us, right? Some of them are priced in, some of them are priced in incorrectly. So I think they present some known risk. And the only problem is that the risk which tends to harm us the most is the one that we are most comfortable with, right? Either we don't know about it, so we are very comfortable because we don't know what that risk is, or we know it completely and it still surprises us, right? So these are the two risks which probably will be very critical. What I see as a manifestation of risk for me today is the absence of margin of safety, right? And if the margin of safety is absent, then there is an analogy that in investing there are two types of securities. Okay, one are eggs and the other is tennis balls, right? So if you throw them, one will bounce back. The egg will not bounce back, right? And as margin of safety rises in any asset, you get more tennis balls, right? What does this mean? That even if an untoward or uncertain outcome were to come true, securities will fall. Nobody can stop them from falling, right? But many will bounce back sharply, and your ability to capture bargains will be much higher. As of today, I think that backdrop is missing in, let's say, domestic equity. Some places, as I said last year also, for example, private banks, that backdrop was available. Maybe it still is available to some extent, but when you do a broad brushing, you will be hard pressed to find such opportunities. So I think that is a risk which we can put in words today, but it is hard to put in words what we don't know today. And what kills us most is things that we think we know, but we do not know, right? And those are the things that we have to be very careful with. You said some opportunities that we are missing today, which could do well. We highlighted some of it, for example, to repeat, is private banks last year. I think that was a good opportunity, continues to be, depending on how you participate. I think gold was one such opportunity in the past. Maybe the silver opportunity currently could be one of them, based on how the margin of safety is panning out. Um, I think these are the only areas which I see, and some other uh, very specific buckets. For example, certain China internet consumer companies, they look attractive. Some apparel companies in US, some biotech names and CDMO names in US and India, they appear very attractive. So these are some opportunities which I think are attractive and they can do well.
Sahil, with this, we come to the end of our discussion and a lot of interesting takeaways. I'll just try to summarize a few of those. One, especially on the valuation, that not many asset classes offer bargain at this particular point of time. If you take last 5 years, we haven't seen even a single correction in India which has been higher than 17%. Worst of the past is not the worst of the future. Direction of stock market is decided by the incremental flows on that particular day. So it doesn't matter what the market has put in into it till today. From a global standpoint, there are opportunities there if one is looking at bottoms up. Prices driven factor versus fundamental factor. That was a very interesting way of putting at it. Most investors are better off thinking about factors investing if the time frame is really long, because at the end of the day, it all converges. Even SIPs are path dependent, which not many people talk about. And in SIPs, the main work is done by time. Uh, all the risks are never priced or can never be priced in the market. But for me, two key takeaways. One is after this, therefore, because of this. And lastly, what you mentioned about tennis balls versus eggs. I had never heard about tennis balls and egg example, and it was really good. Thank you so much for taking out time. And it's a busy day, busy week for you, but you being gracious enough to accept and taking out time for our investors. We can't thank you enough.
Thank you. Thanks a lot for having me. Thanks, Harsh. Thanks, Megha.